The average student loan balance in 2026 is $37,853. That's the number you see in the headlines. But that's not what most borrowers actually end up paying. By the time interest capitalizes, repayment stretches out, and the wrong plan gets chosen, the real cost is often double. Sometimes more. Nobody taught you this in school. That's what this video fixes. Let's start with the actual math. You borrow $37,853. Your interest rate on a federal undergraduate loan in 2026 is around 6.5%. Standard repayment is 10 years. At that rate in term, your monthly payment is $428. You'll pay a total of $51,374. That means $13,500 in interest on top of what you borrowed. That's the best case. That's if you start paying immediately, never defer, never go on an income-driven plan, never miss a payment, and pay it off in exactly 10 years. Most people don't do that. Most people defer during the 6-month grace period. Many defer further during job transitions or hardship. And when you defer, interest doesn't pause. It keeps accruing. And then it capitalizes. That word capitalizes is where the trap really begins. Interest capitalization means that unpaid interest gets added to your principal balance. Once that happens, you're now paying interest on interest. Let me show you what that does. You borrow $37,853 at 6.5%. During a 2-year deferment, maybe grad school, maybe a tough job market, interest accrues at about $2,460 per year. After 2 years, you've got $4,920 in unpaid interest. When your loans come out of deferment, that $4,920 capitalizes. Your new principal is $42,773. Now you're paying 6.5% on $42,773. Your monthly payment goes up. The total interest you'll pay goes up. And you never borrowed that extra $4,920, it appeared because the clock kept running while you weren't paying. Graduate students face this at an entirely different scale. The average grad student borrows $71,000. Graduate Plus loans carry interest rates of 8.05% as of 2026. During a 3-year deferment through school, that's over $17,000 in accrued interest before they've made a single payment. The critical move, if you can afford it even partially, pay the interest during deferment. Even $100 a month during school prevents thousands of dollars from capitalizing. Income-driven repayment sounds like relief. You pay a percentage of your discretionary income, usually 5 to 10%, and after 20 or 25 years, whatever's left is forgiven. Low monthly payment. Sounds great. Here's the trap. If your payment is lower than the monthly interest your loan is generating, your balance grows every month even though you're paying. This is called negative amortization. You make a payment and owe more than you did before. On Save, the newest income-driven plan, a borrower making $42,000 a year with $37,000 in undergraduate loans might pay around $140 a month. But the monthly interest on that loan is $205. Every month, their balance grows by $65 despite making payments. After 5 years, they owe more than they originally borrowed. Then comes the second trap: forgiveness is taxable income. If after 20 years you have $50,000 forgiven, the IRS treats that $50,000 as ordinary income in that year. At a 22% tax bracket, that's an $11,000 tax bill in 1 year. Borrowers who didn't plan for this get hit with a huge surprise tax liability right when they thought they were finally free. PSLF is the exception, public service loan forgiveness is tax-free. But we'll get to that in a moment. The income-driven plan is sometimes the right choice. If you have very high debt relative to income and work in public service, it's the path to tax-free forgiveness. But if your income is going to grow, or you don't qualify for PSLF, the standard 10-year plan costs less in total interest almost every time. Federal loans and private loans are not the same thing. They behave completely differently, and the difference matters more than most people realize. Federal loans come with income-driven repayment options. They have fixed interest rates. They qualify for PSLF. They have deferment and forbearance options. If you die or become permanently disabled, federal loans are discharged. Federal loans are the foundation, they have protections built in. Private loans have none of that. They are issued by banks. The interest rates are variable in many cases. There is no income-driven repayment. They do not qualify for PSLF. If you lose your job, private lenders are not obligated to work with you. Private loans also cannot be discharged in bankruptcy except under extreme circumstances. The refinancing trap falls squarely here. Refinancing federal loans into a private loan to get a lower interest rate sounds smart. If your rate drops from 6.5% to 4.5%, you save real money on interest. But the moment you refinance into private, you lose all federal protections. You lose income-driven repayment. You lose PSLF eligibility. Permanently. Do not refinance federal loans into private unless you are 100% certain you will never need those protections, you are not working toward PSLF, and your income is stable enough to handle any repayment scenario. Most borrowers should leave federal loans federal. Not all degrees have the same return on investment. This is uncomfortable to say, but the math is the math. The Georgetown Center on Education and the Workforce tracks lifetime earnings by major. The highest ROI degrees: computer science, nursing, engineering, accounting. These fields produce median starting salaries between $62,000 and $85,000. With $37,000 in debt, a software engineer is debt-free in 2 to 3 years if they focus on it. The lowest ROI degrees: early childhood education, fine arts, social work, theology. These fields produce median starting salaries in the $32,000 to $42,000 range. Carrying $37,000 in debt on a $36,000 salary means payments consume over 14% of gross income, which strains a budget down to the bone. The critical calculation is the debt-to-income ratio. As a general rule, your total student loan balance should not exceed your expected first-year salary. Borrow $30,000 for a degree that pays $30,000 starting, manageable. Borrow $80,000 for a degree that pays $35,000, financial stress for a decade. If you're currently enrolled and haven't hit that ratio yet, stop borrowing. Work, apply for grants, take a lighter course load. If you're already past it, the strategy shifts to income growth and aggressive repayment, which we'll cover next. Public service loan forgiveness is the most misunderstood program in student loans. Let me give you the actual math. PSLF forgives your remaining federal loan balance after 120 qualifying payments, 10 years, while working full-time for a qualifying employer. That includes government jobs at any level, nonprofit organizations with 501(c)(3) status, and certain other public service roles. The forgiveness is completely tax-free. Here's the math that changes the game. A social worker with $65,000 in federal loans earning $42,000 a year. On the SAVE plan, their monthly payment is around $140. Over 10 years they pay $16,800 total. Their remaining balance, which could be $60,000 or more after interest, is forgiven tax-free. Total cost, $16,800 to eliminate $65,000 in debt. Compare that to standard repayment, paying $675 a month for 10 years, total out-of-pocket $81,000, more than they borrowed. PSLF is extraordinarily valuable for people in lower-income public service careers with significant debt. The catch: you must submit employment certification forms annually, use a qualifying repayment plan, and make all 120 payments on direct loans only. FFEL loans must be consolidated into direct loans first. About 30% of PSLF applications have historically been denied, mostly for paperwork errors and ineligible repayment plans. Track this yourself. Don't trust that everything is being processed correctly without verifying. If PSLF isn't your path and you want to eliminate debt as fast as possible, here is the exact playbook. First, refinance only if you have private loans or are certain you don't need federal protections. A 2% rate reduction on $37,000 saves you roughly $4,000 in interest over the life of the loan. Second, use the avalanche method. List your loans by interest rate, highest to lowest. Pay the minimum on everything, throw every extra dollar at the highest rate loan. This minimizes total interest paid. Third, treat every windfall as a payment. Tax refund, bonus, side income make lump sum payments directly to principal. Even one $2,000 payment on a $37,000 loan at 6.5% saves over $3,000 in interest over a 10-year term. Fourth, increase income before increasing lifestyle. Every raise, every promotion, half goes to loan payoff, half to savings. Do this for 3 years and most people with average debt can eliminate it entirely. Fifth, employer student loan repayment benefits. As of 2026, employers can contribute up to $5,250 per year to employee student loans tax-free. If your employer offers this and you haven't enrolled, do it today. That's free money toward your debt. The student loan trap is real. It's designed to extract maximum interest over maximum time. But it only wins if you don't understand the rules. Now you do. Word count, 1 300 duration, 10-minute end card. Next video, how to negotiate 6 bills lower, V38.